If you invest in Hong Kong stocks, here's a question that matters more than most people think. Do higher dividends help stabilize stock prices, or do they do nothing? In my research paper, I tested this using 354 HKEX-listed companies over 2001 to 2020. You can find the full paper on preprints.org here. I'll break the findings down in plain English, then convert them into a clear investment strategy focused on risk control, not hype. Dividend policy is basically how a company decides to distribute earnings to shareholders. In my paper, I used two widely used proxies, dividend yield and dividend payout ratio. Then I measured how they relate to price volatility, how wildly a stock price swings. A key design choice: instead of only using the opening and closing price, I measured volatility using the stock's highest and lowest price within the year. So we capture the real range of movement, not just where the year ended. This wasn't a small sample. It covered 20 years, hundreds of companies, and thousands of data points. I used correlation first, then panel regression methods, testing fixed versus random effects, and the statistical test pointed to fixed effects as the appropriate model in the main analysis. Here's the headline. In the fixed effects results, both dividend yield and dividend payout ratio are negatively associated with stock price volatility in Hong Kong. In other words, companies that pay higher dividends or pay out a higher portion of earnings tend to have more stable stock prices, statistically speaking. Dividends weren't the only thing that mattered. Larger firms tended to be less volatile, consistent with the idea that big firms attract more coverage and confidence. Earnings volatility was associated with higher stock price volatility, but leverage and asset growth were not statistically significant in the main model, suggesting that in this dataset, those fundamentals didn't explain volatility as strongly as dividends, size, and earnings stability. Why would dividends reduce volatility? One simple explanation is investor behavior. Higher dividend stocks often attract investors who want income and are willing to hold longer. When more shareholders behave like long-term holders, there may be less rapid buying and selling, so prices swing less. Dividends can also act as a signal of financial stability, which can reduce uncertainty. Now let's turn the research into a strategy idea. This is not dividends guarantee returns. This is a volatility management approach. Use dividend policy as a filter to seek steadier stocks. Step 1. Screen for stocks with relatively higher dividend yield and payout ratio, but within reasonable bounds. Step 2. Avoid traps. Extremely high yields can mean the price collapsed for a reason, and extremely high payout ratios can be unstable, especially if earnings are falling. So the focus is quality dividends, not just big numbers. There are a few practical ways to apply this. You can build a stability sleeve inside your portfolio using dividend-oriented, larger, more earnings-stable names. Or you can run a barbell, stable dividend payers on one side, growth on the other. Or treat it like a risk switch. When markets get choppy, lean more into the dividend stability group. To summarize my findings, higher dividend yield and higher payout ratio are linked to lower stock price volatility in Hong Kong. Larger firms are generally less volatile, and unstable earnings increase volatility. If you want the full methodology, variables, and regression tables, the paper made by me is on preprints.org. Use this as a research-based framework, backtest it, and combine it with your own risk controls.